Imagine a world where, Wall Street titans are spending millions of dollars to defend anti-government computer code from theoretical quantum computers.
Right. It sounds completely absurd.
It really does. And at the same time, you've got physical energy grids down in Texas being actively rerouted just to prioritize artificial intelligence over everything else. It sounds like a pitch for a sci-fi novel.
Yeah, but that is actually just a baseline summary of what happened in the financial markets this week.
Exactly. Welcome to the week that was.
Yeah.
If you're listening to this, you are here because you want to cut through the noise of the daily financial news cycle.
And there's certainly a lot of noise right now.
So much noise. So our mission for this edition of the week that was is to do a deep dive into this massive stack of recent market reports, corporate filings, and geopolitical intelligence, just to understand this profound structural transition happening right now in the Bitcoin market.
Because we are looking at a scenario where the foundational computer code of this network is just colliding head-on with the physical and political realities of the global economy. Right.
I mean, this isn't just a story about daily price action or, chart technicals. It's an analysis of how a digital asset reacts when it's thrown into a macro pressure cooker.
And it is a fascinating tug-of-war. I mean, we're going to unpack global energy shocks, massive corporations engineering incredibly complex financial instruments just to hold the asset, physical mining companies abandoning crypto entirely to chase the AI boom.
And, of course, the sudden realization that Bitcoin has become, well, a legitimate tool for international statecraft.
Yeah, it's a dense web to untangle.
It really is. And I think the best place to start untangling that web is by looking at the largest exogenous factor driving the global economy right now, which is, the intersection of geopolitics and energy supply.
Right, you can't just ignore the physical world.
Exactly. You simply cannot understand Bitcoin's recent inability to break through that heavy resistance level around $67,000 or $68,000 without first looking at what is actually happening in the physical world.
Yeah.
And the physical world has been nothing short of volatile lately. I mean, we are tracking a severe military escalation in the Middle East.
Yeah, the recent intelligence reports detail United States military strikes against infrastructure targets in Iran.
Right, specifically noting areas dangerously close to the Darkovan nuclear plant construction site and the civilian nuclear facility in Bushehr.
Which, as you'd expect, prompted retaliatory strikes on U.S. allied sites across places like Kuwait, Bahrain, and Jordan.
And the immediate economic consequence of all that military escalation is a massive disruption of global maritime trade routes.
Yeah, we're closely monitoring Houthi militants enforcing a blockade in the Bab el-Mandeb Strait.
Which is huge. That single maritime choke point handles 12% of all global trade.
Right, and you compound that with ongoing strikes in the Strait of Hormuz, where commercial ship transits have plummeted by 47%.
Well, almost half.
Yeah. And the Strait of Hormuz handles about 1/5 of the global daily oil supply. So when you cut those transits nearly in half, the macroeconomic reaction is just, it's violent.
I mean, Brent crude oil futures spiked aggressively, pushing right past the $100 a barrel mark.
Which immediately establishes a new persistent inflationary baseline. Because energy, it touches every single sector of the economy.
Right. If it costs significantly more to transport goods, literally every consumer product gets more expensive.
Exactly. And that inflation fear caused a massive swing in federal policy expectations. I mean, in just days, the probability of a Federal Reserve rate hike jumped from 12% to 40%.
Before the bond market eventually settled on, an 80% probability that the Fed will just hold rates steady at their current elevated levels?
Right. They are effectively trapped by the cost of energy.
Okay, hold on, though. This is where I really have to push back, because this makes zero sense to me based on the traditional narrative. Well, if Bitcoin is supposed to be this pristine, non-sovereign hedge against fiat inflation, digital gold, as they say, why did the spot price drop toward the $63,600 support level the exact second that oil spiked and inflation fears worsened?
It's a great question.
Shouldn't an inflation hedge go up when inflation expectations actually materialize?
You'd think so, right. But that contradiction is the core of what institutional analysts call the dual mandate conflict of Bitcoin.
Okay, break that down for me.
To understand the price drop, you have to look at the mechanics of who actually holds the majority of the assets float right now. It is largely institutional allocators, hedge funds, asset managers, pension funds.
Right.
When they build their portfolio risk models, they don't necessarily categorize Bitcoin as a safe haven yet. They categorize it within their technology risk bucket.
Oh, I see.
Yeah, it sits in the exact same risk tranche as their shares of Intel, Nvidia, or, the broader NASDAQ 100.
So when energy prices spike and bond yields rise because the market anticipates the Fed keeping interest rates high, the cost of borrowing capital gets really expensive.
Exactly. And the immediate algorithmic reaction for those institutional funds is to de-risk their portfolios across the board. They sell off their broad tech stocks to raise cash, and Bitcoin simply gets dragged down in that initial violent liquidity contraction.
So the algorithms aren't even differentiating, they're just dumping risk.
They're just dumping risk. But the crucial mechanism happens after the dust settles. As the initial sell-off exhausts itself, Bitcoin begins to catch structural bids from a completely different type of investor.
The people actually looking for the inflation hedge.
Right, the allocators actually seeking a non-sovereign hedge against fiat debasement and supply chain weaponization. It basically trades like a volatile tech stock during the initial panic, and then it transitions into an inflation hedge during the recovery phase.
Man, it is essentially having an identity crisis in real time. But wait, if institutional money is acting this way on a macro level, dumping and rebuying based on bond yields, how are the actual corporations holding this stuff on their balance sheets surviving the volatility?
It's getting complicated.
Because just leaving billions of dollars in a digital vault and hoping for the best isn't going to cut it anymore, right?
No, it definitely isn't. The strategy for public companies has evolved far beyond a simple buy and hold mandate. I mean, the opportunity cost of letting an asset sit dormant is just too high when interest rates are hovering where they are.
Right. So what are they doing?
Well, let's analyze Strategy Inc. They are a behemoth in this space. They hold 843,775 Bitcoin.
Which is massive.
Massive.
Yeah.
But their recent corporate disclosures revealed something highly strategic. They didn't buy any new Bitcoin this week. Instead, they sold over $263 million in common stock to build a record $3.2 billion cash reserve.
Wait, which initially sounds bearish. Why would the biggest buyer stockpile cash instead of just buying more of the asset?
Because Strategy Inc. is fortifying its balance sheet against the very volatility we just discussed. They have massive obligations on their preferred stock lines, which pay dividend yields between 8 and 10%.
Oh, so by hoarding $3 billion in cash, they're engineering a financial buffer.
Exactly. They can service their debt and ride out any spot market crashes without ever being forced to liquidate their underlying Bitcoin position.
They are building a moat. That makes sense. But then you look at a company like Bitmine Immersion Technologies, and they are taking a completely different approach by focusing on Ethereum.
A totally different strategy.
They hold roughly 4.8% of the entire global supply. That's about 5.7 million ETH. And instead of just holding it, they are staking 85% of it to generate $247 million in annualized revenue.
Yeah, and staking is the fundamental mechanism that separates a proof-of-stake network like Ethereum from a proof-of-work network like Bitcoin. Bitmine is essentially operating as a massive validator node.
So by locking up their Ethereum to secure the network's transactions, the protocol just pays them a steady yield in return.
Precisely. They have transformed their digital treasury from a speculative holding into an instrument that behaves remarkably like a high-yield corporate bond.
It's wild. And then we get to the outright financial engineering, which brings us to Strive, Inc. They utilize an incredibly complex instrument called a variable rate perpetual preferred stock, or SATA, to fund their Bitcoin purchases.
Yeah, the SATA instrument is fascinating.
The filings show this stock dropped in late June but recovered to near its $100 par value. But how does a company pay a dividend to shareholders when the underlying asset, Bitcoin, doesn't actually produce any cash flow itself?
Well, it requires a brilliant piece of corporate finance. Strive issues the specialized preferred stock to the open market, and they use the capital they raise to buy spot Bitcoin. But to prevent investors from simply selling the stock and crashing its price, Strive commits to paying a continuous daily dividend on those shares.
Where does the cash for the dividend come from? Like, are they selling the Bitcoin?
No, they're not selling the Bitcoin. They are utilizing external cash flows or raising additional targeted capital just to service that dividend. The daily dividend incentivizes the market to keep the stock trading at or above its par value.
Wow.
And because all the pricing volatility is isolated within this specific preferred equity tranche, Strive creates a protective barrier. They can maintain their treasury of 19,000 Bitcoin indefinitely without the risk of a margin call forcing them to sell.
It is a beautifully constructed machine, as long as it works.
Right, key phrase.
But what happens when the engineering fails? Because we saw Satsuma Technology, a UK firm, experience a total collapse this week.
Yeah, that was brutal.
90% of their shareholders had to vote to completely liquidate their entire treasury of 668 Bitcoin. Their equity value fell 99%.
Satsuma basically fell victim to convertible note creditors. A convertible note is a type of short-term debt that converts into equity, shares of the company if it isn't paid back.
Right.
When the crypto market experienced a downturn, Satsuma couldn't service their traditional debt. So those creditors legally forced the conversion of their debt into equity, massively diluting the existing shareholders.
It creates a death spiral.
Exactly. The only way out was to liquidate the core Bitcoin treasury at the exact worst time in the market cycle just to pay off the creditors.
It's like we've moved from the Wild West gold rush where people just, buried gold in their backyard and hoped nobody stole it, to the industrial era where companies are building these massive, complex financial factories on top of the gold.
That's a great analogy.
And if the factory is built poorly, it just collapses under its own weight.
The era of passive corporate adoption is totally over. You either engineer a robust financial structure to survive the volatility, or your creditors will devour your balance sheet.
So corporate treasuries are hunting for yield and efficiency. But what about the physical machines that actually make the network function?
The miners.
Yeah, the mining companies securing the Bitcoin network are facing what looks like an existential crisis in their filings. And surprisingly, it has almost nothing to do with Bitcoin itself.
No, it doesn't.
It's entirely driven by the boom in artificial intelligence.
We measure the health of the mining sector through a metric called hash price. Think of hash price as, the hourly wage a mining machine earns for providing computing power to the network, minus the cost of the electricity required to run it.
Okay.
Right now, hash price is sitting near multi-year lows at $30.60 per petahash per second per day.
So that hourly wage is literally dropping below what it actually costs to plug the machines into the wall.
Precisely. The profit margins have compressed so severely that older generation ASIC mining machines are operating at a net negative. They are literally burning capital.
Which perfectly brings us to the AI pivot.
Yeah.
Look at companies like LM Funding America. They are undergoing a complete structural metamorphosis.
Yeah, changing everything.
They're changing their NASDAQ ticker symbol, renaming themselves to Power Compute Inc., and taking 26 megawatts of power capacity in Oklahoma and Mississippi and just unplugging it from the blockchain.
And routing that power directly into high-performance computing and AI infrastructure.
Exactly.
Bitdeer is executing a similar strategy, too. They recently leased a massive data center facility in Malaysia specifically to deploy high-end NVIDIA systems.
Oh, wow.
Yeah, they're expanding their AI cloud operations to a $76 million annualized run rate.
And even when these physical infrastructure companies aren't pivoting directly to AI data centers, they are playing the grid itself. Like Riot Platforms reported a $32 million fiat yield simply by shutting down their mining rigs and selling their pre-purchased electricity back to the Texas ERCOT grid during peak demand hours.
Right.
They made more money not mining Bitcoin than they would have by running the machines.
This physical transition raises a critical question about the long-term security budget of the Bitcoin network. Electricity and physical grid interconnects are finite, premium resources.
Absolutely.
The White House recently launched the Genesis mission, explicitly directing federal funding and research toward expanding AI facilities. AI data centers and Bitcoin miners are now locked in this fierce bidding war for the exact same power grid connections and the exact same physical real estate.
So a megawatt of power is simply assigned a higher financial valuation right now if it's processing a large language model than if it is hashing a Bitcoin block.
Yeah.
And miners are rational actors. They're just going to direct their electrons to whichever compute task pays the highest margin.
Exactly. Energy access is the ultimate bottleneck. And as electricity becomes this premium global resource, the legal and sovereign frameworks governing these digital assets are causing massive friction.
Let's examine that regulatory battlefield. Because the domestic gridlock in the United States over how to classify this asset class is reaching a boiling point, especially with the Digital Asset Market Clarity Act.
The Clarity Act, yeah.
Right.
The intent of the Clarity Act is to finally establish a jurisdictional boundary. The framework proposes that the Securities and Exchange Commission, the SEC, would retain oversight over investment contracts and tokenized securities.
Okay, makes sense.
Meanwhile, the Commodity Futures Trading Commission, the CFTC, would govern the spot markets for digital commodities, which would include Bitcoin.
And the CFTC is already consulting on how to handle 24/7 trading environments, which honestly is a massive paradigm shift.
Oh, totally.
Traditional regulators are built around agricultural or energy markets that ring a bell at 4 p.m. and then just close on the weekends. A market that never sleeps requires entirely new surveillance mechanics. But the legislation is hitting a massive wall of resistance from the traditional banking lobby, isn't it?
It is. The Bank Policy Institute and the American Bankers Association are aggressively lobbying against the Clarity Act, and their opposition centers on a very specific provision regarding stablecoins, digital tokens pegged to the US dollar.
Right.
The bill contains language that could allow stablecoin issuers to pass on interest yields to the people holding the tokens.
Let's break down why that terrifies a bank. A traditional regional bank relies on consumer deposits to fund its lending operations.
Yeah.
You deposit your paycheck, they pay you a fraction of a percent in interest, and they loan that money out for mortgages at, say, 7%.
Right.
But if a consumer can hold a yield-bearing stablecoin on their phone, essentially a digital dollar paying a 5% yield, directly backed by short-term U.S. Treasuries, why would anyone keep their savings in a local bank?
They wouldn't, and the deposit flight would be catastrophic for traditional lending models.
Yeah.
The Treasury Department's internal estimates suggest that up to $6.6 trillion in deposits could migrate out of traditional regional banks if yield-bearing stablecoins are fully legalized and integrated into consumer applications.
6.6 trillion.
Yeah. It would effectively hollow out the ability of local banks to create credit.
So domestic banks are fighting a rearguard action just to protect their deposit base. But while the U.S. is bogged down in lobbying, the international stage is moving rapidly.
Very rapidly.
The Russian government is actively advancing legislation to legalize cryptocurrency for international trade settlements, specifically engineering a way to bypass Western economic sanctions.
What is highly strategic about the Russian approach is that they are maintaining a strict ban on domestic digital asset payments.
Oh, really? So you can't buy coffee with it there?
No, exactly. The central bank retains absolute control over internal monetary policy and the ruble, but they are weaponizing the permissionless nature of the blockchain strictly for cross-border trade.
Here's where it gets really interesting, because the cognitive dissonance of this whole situation is just staggering. You have Russia using the blockchain to evade the U.S. financial system. You have the U.S. banking system terrified of digital assets destroying local lending. But simultaneously, the U.S. State Department just launched what they are calling the Freedom Tech Excellence Program.
Right. It is a remarkable pivot in sovereign strategy.
Yeah.
The State Department is partnering with defense and intelligence contractors like Palantir and Anduril. Their explicit goal is to utilize Bitcoin and robust cryptography to assist foreign citizens in bypassing authoritarian digital surveillance and state-level capital controls.
They are actively weaponizing Bitcoin as an instrument of strategic diplomacy and soft power abroad, while domestic regulators at home are still trying to figure out if it is an unregistered security.
It's quite the paradox.
The executive branch is acknowledging that permissionless networks are vital global infrastructure for circumventing adversarial surveillance. I mean, they're treating it as a strategic national asset.
And if the State Department is viewing the network as vital global infrastructure, well, traditional finance is treating it exactly the same way. The institutional market has moved entirely past the initial phase of price speculation. Wall Street is actively building long-term structural defensive moats around their digital asset investments.
A perfect example of that is the European expansion we saw this week. CoinShares launched a UCIS-compliant Bitcoin mining ETF on the Deutsche Börse Xetra.
That's a huge deal.
It is. For context, the UCITS framework is a highly stringent, highly regulated European standard for mutual funds.
Right.
Highly restricted European pension funds and private wealth managers are legally prohibited from holding raw, unregulated digital commodities.
Right, so the asset managers engineer a legal wrapper. By launching this specific ETF, they unlock access to a 26.3 trillion euro regulated fund market.
Trillion with a T.
Yep. It provides a fully compliant backdoor for legacy capital to get exposure to the economics of the Bitcoin network without violating their strict charter mandates.
We are also seeing a massive hunt for extreme yield in the U.S. institutional markets through products like the Yield Max ETFs, specifically tickers YBIT and MSTY.
The covered call strategies.
Yeah. These funds utilize a strategy called synthetic covered calls. Imagine you own a house and you rent it out to collect steady income. But the rental contract says if the house value skyrockets by 50%, the renter gets to keep the profit above a certain price.
Right.
You get massive guaranteed income today, but you cap your upside tomorrow. That is exactly what these ETFs are doing with Bitcoin and MicroStrategy stock.
Institutional capital has an insatiable appetite for fiat-denominated income right now. These covered call ETFs are paying out massive dividend yields, between 46% and 56%.
It's insane.
It proves that legacy funds are willing to sacrifice the potential for Bitcoin's price to go to the moon purely in exchange for a guaranteed massive dividend yield right now.
But every single one of these financial products, the ETFs, the covered calls, the massive corporate treasuries holding billions in cash buffers, they all rely on one fundamental assumption.
That the underlying computer code of the Bitcoin network will never break.
Exactly. Which brings us to the creation of the Bitcoin Security Consortium.
Right. BlackRock, Coinbase, Block, and MicroStrategy have pledged a $15 million independent fund deployed over 3 years, specifically to protect the Bitcoin network from future post-quantum cryptography threats.
Let's break down the quantum threat because it sounds incredibly abstract to most people. Essentially, quantum computers operate using quantum bits, or qubits, which allow them to process complex equations exponentially faster than the traditional binary computers we use today.
Yeah.
In theory, a sufficiently powerful quantum computer could eventually crack elliptic curve cryptography, which is the exact mathematical lock that secures every single Bitcoin wallet and transaction on Earth.
Well, the consensus among cryptographers is that a quantum computer capable of breaking this encryption does not actually exist yet.
Right. However, conservative industry estimates place that capability within a 10 to 15-year horizon.
Yeah.
It represents a long-tail systemic existential risk. If that specific cryptography is broken, the integrity of the ledger is compromised, and the entire trillion-dollar network goes to zero overnight.
So Wall Street titans are literally pooling millions of dollars to pay independent software developers to upgrade Bitcoin's open source code so that it can survive a theoretical quantum computing attack a decade from now.
Yes. By funding these quantum computing defenses, traditional finance is officially internalizing the responsibility for the protocol's survival.
Wow.
They are no longer just passive speculators betting on a chart. They are treating Bitcoin as permanent global financial infrastructure, and they're taking it upon themselves to ensure the foundation doesn't crack.
So what does this all mean for you, the listener? We have covered a massive amount of ground in this edition of The Week That Was. We looked at how Houthi blockades in the Red Sea and spiking energy costs are shifting Federal Reserve policy and dictating institutional portfolio allocations.
We examined how massive corporate treasuries are engineering preferred equity structures just to survive the volatility of holding the asset. We saw physical miners unplugging their machines to defect to the AI data center boom.
And we watched the U.S. State Department deploy Bitcoin as a geopolitical weapon of soft power, even as Wall Street spends millions to defend the underlying code from theoretical quantum computers.
Understanding the mechanics behind these structural shifts is the only real shortcut to seeing where the financial world is actually heading. If you only look at the daily price fluctuations, you miss the tectonic plates moving underneath the surface. The fundamental plumbing of the global economy is being completely rewired right now.
It really is.
And I want to leave you with a final thought to mull over. When Bitcoin was originally designed in the dark aftermath of the 2008 financial crisis, it was explicitly created as a decentralized, peer-to-peer rebel currency.
Right. The entire point was to bypass the banks, bypass the state, and operate completely outside the traditional financial system.
Exactly. But look at where we are today. Its largest holders and its most aggressive defenders are Wall Street titans like BlackRock, massive corporate treasuries, engineering complex equity, and the U.S. State Department preparing for quantum warfare. So you have to ask yourself, has Bitcoin actually conquered the traditional financial system? Or has the traditional financial system successfully captured the soul of Bitcoin?
That is a profoundly important question to consider as we watch this space mature.
Thank you for joining us for the week that was. Keep questioning the consensus, keep looking past the noise, and we will see you next time.